What is Murabaha? It is a particular kind of sale based on cost plus profit. The seller discloses the cost to the buyer and adds a certain profit to it. It may be defined as a contract wherein the Islamic bank, upon request by the customer, purchases the asset from a third party, supplier or vendor and resells it to the customer, either against immediate or on a deferred payment. Limitations of Murabaha. It cannot be used as a substitute of running finance, which provides cash for fulfilling various needs of the client. The borrower is allowed to get finance for working capital, that is, commodity financing, purchasing of raw material, pre-shipment export finance, and funding against imports. It is a fixed price sale, and normally for short-term transactions. However, it may be used for long-term financing. Banking Murabaha. It is something different from the Murabaha used in normal trade. The institution, upon the request of the customer, purchases an asset from a supplier or vendor and resells the same to the customer, either against immediate or on deferred payment, and it is called Murabaha to the purchase orderer. It is a bunch of contracts completed in steps, and their sequence of execution is extremely important. Conditions of Murabaha under Sharia guidelines. Here are some conditions of Murabaha financing, which are as follows. Subject of sale, whether it is physical or constructive, should be in physical or constructive possession of the seller. The sale should be instant and absolute. The subject matter should be property having value. It should not be used for non-Sharia compliant purposes. The subject matter should be specific and identifiable. Buyback arrangement is not allowed. Delivery and price should be certain. A sale must be unconditional, and it's only to purchase some tangible goods or commodity. Stages of the Murabaha agreement. It has 4 stages: promise, agency, acquiring possession, and execution. Stage 1. Promise. The client approaches the bank for facility through Murabaha. The client and the bank sign an agreement to enter into the agreement. Then, the client submits the purchase requisition to the bank. Stage 2. Agency. The client approaches the bank for facility through Murabaha. The client is appointed as an agent to purchase goods on the bank's behalf. Then, the bank deposits money into the client's account for the purchase of the goods. Stage 3. Acquiring possession. The client purchases goods on the bank's behalf and takes their possession. And Stage 4. Execution. The client makes an offer to purchase the goods from the bank. The bank accepts the offer and the sale is concluded, and finally, the client pays the agreed price to the bank according to an agreed schedule, usually on a deferred payment basis, which is called Bai Mu'ajjal. Different relationships at different steps. Master Murabaha agreement, the promise to purchase and promise to sell. Agency agreement, relation of principal and agent. Purchase and payment of purchase price. Relation between the bank and the supplier is that of a buyer and seller. Offer and acceptance. Relation of the buyer and seller comes into operation between the bank and the client. Payment of Murabaha price. Relation between the bank and the client is that of debtor and creditor. Case study. Ali sold a watch to Zain for $1,000 on 3 months credit. At the expiry of the credit time, Zain requested 1 month extension. The extension granted by Ali with the condition that the new price will be $1,050 as its market price has been increased. This argument seems logical, and it seems to be according to the Quranic order, where believers have been advised to carry on the sale transaction with the mutual consent. So, is this transaction halal or haram? According to Sharia, it will be a rebar-based transaction because the price must be fixed at the time of deferred sale, and it cannot be changed. Either the payment is made before or after the agreed period. So the $50 amount which was added later in lieu of the market factor is rebar. Applications of Murabahah. It can be used to finance the purchase of any assets which are recognized as valuable in Sharia. It is widely used for import finance, export finance, house financing, car financing, and working capital financing. Important issues in Murabahah. Fresh purchase. Fresh or actual purchase is an essential part of Murabahah, and the purchase price should be paid directly to the supplier. Promise to purchase. Since the promiser has caused the institution to incur expenses or liability, it's mandatory on the promiser to fulfill the promise, otherwise he may be compelled by the court. Securities against the Murabahah price. The institution may ask the customer to furnish a security. However, the customer will furnish a security after the Murabahah price is determined. It is permissible that the sole commodity itself is given to the seller as a security. The interest-bearing instrument should not be taken as securities. How the risk of default is covered. In case of late payment, an additional amount cannot be charged as penalty. To solve this problem, the client will undertake in Murabahah agreement that in case of late payment, he shall pay the penalty to the charity account maintained by the bank. This penalty is calculated on the basis of percentage per annum for each day of default. Rollover of Murabahah. Transaction cannot be rolled over or repriced for a further period, because Murabahah is a sale agreement and not a loan. However, its rescheduling is allowed. Rebate on earlier payment. If the customer makes early payment and there is no commitment of discount from the institution, then the institution has the sole discretion in allowing the rebate. In Sharia standards, it's prohibited to give rebate to the client on early payment, so such issues should be brought in the knowledge of the Sharia advisor.